This video is going to be all about breakout trading for beginner traders. So breakouts in the market can be really appealing because of the favorable risk to reward ratio that they can offer, and also because they move so quickly. So if you get it wrong, you understand very quickly, and it can be very refreshing for traders who find it stressful when they're in an open trade for a long time and they don't know which direction it's going to go in. However, there are some really specific characteristics of breakouts in the market. And if you don't understand them properly, that risk to reward ratio is actually going to go against you. And that instant feedback is just going to be your stop loss getting hit over and over again. So in this video, we are going to take a deep dive into breakout trading for beginner traders so that you can understand the specifics of breakouts in the market. If you are excited to learn, make sure you hit the thumbs up button before we get started. And if you want to see more content like this, then make sure to subscribe to Thinkmarkets now as well.
So first of all, what is a breakout? A breakout is a big move in the market out of a previous area of consolidation. So often what happens before a breakout is that the market is moving with very little volume in very small candles, often sideways with no direction. And then suddenly, very quickly, you will start to see a lot of volume entering the market, and you could see a big sudden break of that area. So why this can be quite difficult if you are a new trader is because often the area of consolidation preceding the breakout can feel very tedious, very slow, and like the market is never going to do anything. But the actual breakout often happens very quickly. And timing is important with breakout. The reason why it happens like that is often the breakout can be a result of news being released. So often a big breakout can happen because either pre-planned news data like CPI, NFP, or an interest rate decision, or perhaps something is going on, or a meeting's being had. The Fed Chair Jerome Powell is speaking, or whatever's going on in the country of the market that you trade. And often before news releases, the market actually moves very slowly because traders aren't getting so involved because they want to wait for the news to happen to make a decision on their position in the market. And that is why you do often see this very slow move in the run up to a breakout, and then it all seems to happen very quickly. So if you understand that's why it's happening, the first step is to keep an eye on the economical calendar on Thinkmarkets so that you can see when the high impact news is being released. First of all, you can understand that often before them, there will be very little volume in the market, and this is often a good time to sit out. But you will also get the exact time that the news release is scheduled to come out, and that's obviously very important for timing. To draw on your area of consolidation, the rectangle tool on Thinkmarkets is really helpful. So you want to go from the top of the area to the bottom. So here, that's the lowest candle. We're just going to draw that there to the top of the area. Can you see that these candles are very small? In this particular case, this is because it was the previous session, and usually the US 30 doesn't have a huge move in the previous session, but then when New York opens, it does have a big move. So timing is very important when you're looking at breakouts. One thing which can trip you up if you are a beginner trader is that fakeouts are fake breakouts, as the name suggests, and they do happen quite often. So you want to be aware that fake outs are possible. They can happen at any time. When you think it is a genuine breakout, it may just be a fake out. And for that reason, it's really important that you always use a stop loss and you make sure that you do trade with a favorable risk to reward ratio. If you cannot get a good risk to reward ratio, it may not be worth taking the trade because it may just be a fake out. It's only worth it if you can get that RRR in your favor. So in this example here, if we just drag this area across, you can see that we had a fake out here. One really common characteristic of a fake out is that the wick of the candle will break above the area rather than the body. Wicks show price rejection, whereas the bodies show certainty. So if you start to see lots of wicks poking out of one side, that's actually a bad sign. Another characteristic of breakouts, which can trip you up if you are a beginner trader, is that often there are retests to the area before it continues. This is another reason why you want to be really careful with your risk to reward ratio and why you don't necessarily want to rush into the trade. Because the market often does come back before going back in the way it was going, you don't want to have a really large stop loss because there is a good chance that you will get stopped out. It's only worth getting in if you can get a good stop loss, and you want to make sure that your stop loss is within the consolidation zone. Many traders will actually wait for the retest to happen and then they will enter. It's a less aggressive way of trading, but it means that they will get less stop losses hit. Another thing that you want to look out for in breakout trading, I'm going to draw a fake zone here, is you want to look for the number of taps to the area. This is something that you can observe whilst the market is in consolidation, and it can give you clues as to what direction the market is looking to break out into. The more it kind of clusters in one side, the more likely it is to break out of that side. So if you start to see a wedge forming and it all sort of crowding around the top, you may start to see it breaking out above this area here. As I mentioned before, if you start to see the wicks poking out, that's actually a negative sign. So that might mean that you might see a move then to the downside. The wick shows that the area above here is actually being rejected.
So now you understand the basics of breakout trading for beginner traders. You definitely don't want to rush in to testing this out on a live account. So the next step, if you are interested in what you saw in this video, is to head over to the Traders Gym at Thinkmarkets. It's a simulator, so you can test out a trading strategy using virtual money, and you can find out exactly what the success rate is and if there's anything that you need to tweak before you decide to go live. If you found this video helpful, make sure you give it a little thumbs up and don't forget to subscribe to Think Markets now as well.